Imagine buying a dividend growth ETF and seeing zero growth for 6 years. That's the reality for anyone who bought VHYL back in 2019. But with the market shifting in 2026, has the story finally changed? Welcome back everyone, I'm the Swedish dividend investor. So today we're going to take a look at Vanguard FTSE All World High Dividend Yield UCITS ETF, ticker VHYL or VGWD, a very popular and large dividend growth ETF. I made a video about this ETF at the end of April last year, so I figured we will take a look at it for 2026. We will go through what the ETF is all about and what index and strategy it follows, size, fees and current yield, holdings, sectors and country allocation. We will do a performance check against other ETFs. We will take a look at the dividend history and yield. We will do a projection of the dividend growth. And finally, we will do a valuation and compare it to last year. As always, this is not financial advice. I'm just sharing my investment journey, my experiences and my analysis. Read the full disclaimer in the description. Alright, the fund employs a passive management or indexing investment approach through physical acquisition of securities and seeks to track the performance of the FTSE All World High Dividend Yield Index. The index is comprised of large and mid-sized company stocks, excluding real estate trusts, in developed and emerging markets that pay dividends that are generally higher than average. The fund attempts to 1. Track the performance of the index by investing in a representative sample of index constituent securities. 2. Remain fully invested except in extraordinary market, political or similar conditions. That last one is a bit weird. And in their key investor information document, they clear it up somewhat, where they also add where the fund may temporarily depart from this investment policy to avoid losses. They also write the fund may use derivatives in order to reduce risk or cost and or generate extra income or growth, such as share, bond or security. So that's good to know. So the fund size is 7.8 billion euros. The total expense ratio is 0.29% and the fund is domiciled in Ireland. The current yield is around 2.6%, but it usually trades with a yield of around 3 to 3.5%. They have quarterly distributions and they pay in March, June, September and December. Taking a look at their holdings, as of the 31st of March 2026, they hold 2,339 stocks, compared to the index's 2,435. Their top 10 is the following: ExxonMobil, JP Morgan Chase, Johnson & Johnson, Chevron, AbbVie, Home Depot, Cisco Systems, Merck, and Coca-Cola. We can already see the all world, meaning US focused, but at least we don't have the usual suspects of Nvidia, Apple, and Microsoft in the top. These are more staple dividend payers. Their sector allocation is the following: biggest to smallest, financials, industrials, healthcare, energy, consumer staples, consumer discretionary, utilities, technology, basic materials, telecommunications, and a tiny bit into real estate. I thought they excluded REITs. Top 10 country allocation from biggest to smallest. US at over 40%. Japan, UK, Canada, France, Switzerland, China, Australia, Germany, and Taiwan. So, all in all, a very diversified ETF, but with a 40% allocation towards the US. Let's do a performance check. I've done this a bit different this time. I added iShares Core MSCI World ETF for another global comparison, the S&P 500 and VDIV, another great dividend ETF. Year to date, we see VDIV in the lead with its 9.22%, VHYL at 9.14%, MSCI World 4.73%, and S&P at 3.9%. For the 3-year performance, we see VDIV at 69.96%, S&P at 65.08%, MSCI World at 59.65%, and VHYL at 50.46%. 5-year. VDIV 125.61%, S&P 83.35%, MSCI World 72.37%, and VHYL at 70.94%. And for the max time frame, with the start in May of 2019, S&P at 158.51%, VDIV 151.4%, MSCI 132.42%, and VHYL at 97.71%. Alright, not too shabby, I would say. It is hard to beat VDIV's past performance. They really took off in 2022. So, to summarize the ETF so far, VHYL is a huge ETF with quarterly dividends and a yield in the range of around 2.5 to 3.5%, with a decent total expense ratio of 0.29% and asset under management of 7.8 billion euros. It's well diversified as far as holdings goes, with over 2,300 companies. They follow a passive index strategy. They focus on above average dividend yield, and it's pretty tilted towards the US with a 40% exposure. I'm a small creator on YouTube. Hitting the like, commenting and subscribing is an easy way to help out the channel. Thanks. Alright, let's have a closer look on the dividends. As shocking as it is with European dividend growth ETFs, we see a pretty big cut in 2020 of almost 27%. The last year dividend was $2.2721, a growth of 8.3%. But the first dividend in March this year was a bit lower than March last year. I took the liberty to convert it to euros so we know their yield, since the price is in euros. The current dividend yield is at 2.55%. We see a 3-year compound annual growth rate of 1.51%, 5-year CAGR of 6.92%, and a 10-year CAGR of 3.77%. So pretty slow long-term growth, I would say. It took 6 years to surpass the 2019 dividend. So basically, zero growth in 6 years if you bought in 2019. So let's do a 10-year projection of the dividend to see where our yield on cost would end up if we bought today. Remember guys, this is just simple math and what ifs. I used the 2025 dividend and the growth start this year instead of 2027. So let's run with the CAGR numbers from before. If the growth is real slow, 1.5%, the 10-year yield on cost would be 3.01%. Ouch. 3.77% growth. We could be looking at a yield on cost of 3.84%. And if the 5-year CAGR of 6.92% plays out, we could see a yield on cost of 5.33% 10 years out. Alright, let's head on over to the valuation. Why do we do a valuation? So we don't overpay for an investment. We want to be able to somewhat guesstimate what kind of returns we could get over a 10-year period. We use a growth rate to project the dividend growth 10 years forward. A terminal multiple. This is what kind of yield investors give the investment 10 years forward. A high multiple means a low yield, so a higher price, and vice versa. We also use a discount rate. This is our required return, and it's used to discount the sum value back to today, and we get a present value. We use 3 scenarios: normal, best and worst case. Finally, we do a mixed valuation to get the fair price between all the scenarios. The present value is what we would need to pay to meet our required return. I've gone with a discount rate of 10% for all cases, starting off with the normal case. I've gone for a growth of 3.5% for 10 years. Remember, we are trying to use conservative numbers. If we use too exuberant growth rates, the present value will be higher. A terminal multiple of 33, so investors value it with a 3% yield 10 years out. We get a present value of 47.48 euros. For the best case, I've gone with a 6.5% growth for 10 years and a terminal multiple of 40. That means a 2.5% yield 10 years out. We get a present value of 68.68 euros. For the worst case, I've gone with a 1.5% growth for 10 years and a terminal multiple of 25. So investors give it a 4% yield 10 years out. Now, this isn't the worst case, but we will use a higher margin of safety in case we were too exuberant. You could also look at this as high growth for 2 years, followed by a cut and then some low growth. We land at a present value of 34 euros. Let's wrap it up with the mixed valuation. I've gone with a probability of 60% for normal case and 20% each for best and worst case. We land at a fair price of 49.03 euros or 44.12 euros with a 10% margin of safety. That's a fair bit from today's price of 75.57 euros, about a 40% price drop. Jeez. But remember, this is for a 10% annual return. If we change the discount rate, the required return, to 5%, we can see the mixed valuation without margin of safety is somewhat close to today's price. This could all change if they grow their dividend faster. Changing the best case growth to 7.5% gives us a present value of 74 euros. But that is just speculation, and in my opinion, it is better to go with the more conservative numbers. So last year's valuation landed at 37.59 euros, and they were trading at around 62 euros. However, I used even more pessimistic numbers then. So, what's my conclusion? I would say the valuation is pretty stretched. Hoping for price gains right now is pure speculations when we look at the numbers. I would say stay away from this one until they come down to earth a bit. There are better opportunities, like LDGL, link in the description, where I used pretty conservative numbers and it is fairly valued. Now, I am pre-recording this at the 19th of April, so maybe the market has crashed when this comes out. Who knows? I get some people like the VHYL and VHYL strategy, buy every month to dollar cost average, and there is nothing wrong with that. But from my viewpoint, buying at today's price and having a 10-year yield on cost of under 6% in the best case and taking the risk of valuation correction is simply not worth it. I want to know your view on this. I know some of you hold this, and I want to hear your take or your strategy for VHYL. Otherwise, tell me how wrong I am in the comments. But that's it for today, guys. I will see you in the next one. Until then, stay smart, stay patient, and keep stacking those dividends. Ha det gött!